The U.S. macro environment deteriorated meaningfully over the month as geopolitical shocks, trade disruptions, and tightening financial conditions converged into a more persistent stagflationary regime. The Iran conflict remains the dominant macro driver, with crude prices rising more than 40% since the onset of hostilities in options markets, pricing a near-term move toward $150 and even tail risks of $200 per barrel. The transmission into the real economy is already visible. U.S. import and export prices recorded their largest increases since 2022, while S&P Global PMI data shows business activity slowing to its weakest pace in nearly a year, even as input costs accelerate. Growth momentum has clearly softened. Q4 GDP was revised sharply lower to 0.7%, while real consumer spending was effectively flat in January, pointing to a fragile starting point before the full impact of the energy shock. At the same time, inflation expectations are re-accelerating, with consumer surveys showing a marked rise in year-ahead expectations alongside declining sentiment, reinforcing the shift toward a negative supply shock environment rather than a demand-driven slowdown. Labor market dynamics are becoming increasingly bifurcated, signaling early-stage deterioration beneath still resilient headline indicators. Non-farm payrolls declined by over 90,000 in February, with unemployment rising back to 4.4%, while forward-looking estimates suggest the oil shock could subtract roughly 10,000 jobs per month over the course of the year. However, continuing claims have fallen to 1.8 million, the lowest level in nearly 2 years, indicating that layoffs remain contained and that labor hoarding may still be in play. This divergence is echoed in survey data. CFO and CEO confidence held up earlier in the quarter, but has weakened notably following the escalation in geopolitical risks, while small business optimism has declined for a second consecutive month. Critically, the consumer remains uneven. High-income households continue to exhibit strong wage growth and consumption patterns, masking softness among lower-income cohorts who are more exposed to rising gasoline and food prices. Housing adds another layer of fragility, with mortgage rates rising to 6.38%, new home sales falling to their lowest level since 2022, and affordability constraints tightening further despite bipartisan policy efforts to boost supply. Together, these dynamics point to a labor market that is no longer a clean source of strength, but rather one that is gradually losing momentum. Financial markets are increasingly reflecting this regime shift, with volatility rising across rates, credit, and equities. While U.S. equity funds recorded a significant $37.2 billion inflow during a brief window of de-escalation optimism, this followed sizable outflows earlier in the month, underscoring the fragility of investor sentiment. Beneath the surface, more structural cracks are emerging. The valuation premium of U.S. technology equities has compressed to its lowest level in 7 years, signaling a repricing of long-duration growth assets in a higher rate, higher uncertainty environment. At the same time, stress in private credit is intensifying. Major platforms have begun restricting withdrawals, while default rate projections are rising toward 8% in the base case and potentially as high as 15% under more adverse scenarios. Credit spreads have widened to multi-month highs, particularly in sectors exposed to technological disruption and higher refinancing costs. In sovereign markets, the traditional safe haven role of U.S. Treasuries is being challenged. Foreign central bank holdings have declined by $75 billion in just 4 weeks, approaching levels not seen since 2012, while the MOVE index has surged, reflecting elevated rate volatility and a repricing of inflation risk. Simultaneously, capital is rotating defensively, with money market fund assets reaching record highs and cash allocations rising to levels last seen during the early pandemic period. Policy constraints are tightening at precisely the wrong time. The Federal Reserve has maintained rates and signaled a hawkish bias, emphasizing that any easing will be contingent on tangible progress in disinflation. Markets have responded by pushing out the timing of rate cuts, with only around a 50% probability of a single 25 basis point cut priced for this year. This reflects the growing tension between weakening growth and persistent inflation pressures, the latter reinforced by energy shocks, rising producer prices, and supply chain disruptions linked to the Strait of Hormuz. Fiscal and trade policy uncertainty adds another layer of complexity. The Supreme Court's ruling on tariffs has triggered a wave of litigation that could result in $182 billion in refunds, introducing retroactive policy risk for corporates and complicating government revenue projections. At the same time, new tariff investigations across 60 economies and efforts to reimpose trade barriers suggest that trade fragmentation will remain a structural headwind. Even measures aimed at stabilizing energy markets, such as the release of 400 million barrels from strategic reserves and temporary waivers on Russian oil, highlight the extent of underlying stress rather than resolve it. Against this backdrop, global trade growth is already projected to slow sharply to 1.9% this year, amplifying downside risks to U.S. external demand. From a portfolio perspective, the environment argues decisively for a more defensive and diversified stance. Inflation hedges should remain core allocations, with energy, commodities, and inflation-linked bonds benefiting from both realized and expected price pressures. Duration exposure should be managed cautiously, as term premia rebuild and rate volatility remains elevated, limiting the traditional hedging role of long treasuries. Within credit, the focus should shift toward higher-quality issuers and liquid public markets, while exposure to private credit and highly leveraged segments should be reduced given rising default risks and liquidity constraints. Equities require a more selective approach. The compression in technology valuations suggests reduced downside asymmetry, but earnings risks remain elevated in a slowing growth environment. Preference should be given to sectors with pricing power, real asset linkage, and balance sheet strength. Finally, elevated cash levels and optionality are not merely defensive. They are strategic in a regime characterized by episodic volatility, policy uncertainty, and rapid repricing across asset classes. In short, the U.S. economy is transitioning away from a soft landing narrative toward a more unstable equilibrium, where preserving capital and maintaining flexibility are as critical as generating returns.